So let's see, Ernest, how have you been taking the trades this week, or how's it been?
I think
Yeah, you bet I have.
Hold on, I'm muting somebody who was a little garbled. You've been taking the trades, so you making money?
I've made money twice and lost money twice.
Well, and that's just been trading the SPY. Oh yeah, you missed out on Friday's trade, didn't you?
No, I don't think so. Was that August 12th?
Well, Friday was the 9th. We closed out a profit on the 12th, and then we closed out another profit on the 14th. And as long as we stay low on the SPY today, we'll have another winner for Friday.
Yeah, those were the two that I made a profit on.
Okay, good.
My numbers were a lot different than yours, but profit nonetheless.
Yeah, so as the price of the SPY goes up and down, it can turn from a credit to a debit, but at the end of the day, it's still a directional play, and we end up making about the same, give or take 10, 20 cents. So last webinar, we kind of went through that. Actually, our customer webinar yesterday, we went through a lot. Let's see if we could get a hello from some more folks out there. Kate, I see your audio is live. Can you say hi?
Hi, how are you?
Good. Where are you dialing in from today?
Connecticut.
Connecticut. All right. And have you been taking any of the trades?
Actually, no, I didn't.
Watching?
No, I didn't watch either.
Okay. Well, at least you're here on the webinar. That's a good starting point.
Yes, thank you.
Now, do you know how to do options?
Yes.
Okay, good. All right. Kay Pruss, can we get a hello from you?
Yeah, how you doing? I missed yesterday's trades though, but I'm here today.
All right. Well, no problem. We're not trying to get rich or poor on any given trade alert. It's all about playing the odds and doing it over and over and over and over and over again. So you're not missing out on a whole lot as long as you get back on track here. How about Robert? Can you say hello? Let's see, maybe he doesn't have his audio yet. Oh, we got some more people in. Tom Sharp.
Hello.
How's it going, Tom?
I'm doing well, thank you.
And did you manage to take any of the trades?
Yeah, I joined about 8 or 9. I've taken about 3 or 4 of them so far.
Okay, great. Theodore, you want to say hi?
How are you guys doing?
Doing good. How about you?
I'm doing good. Actually, I have not taken any of the trades. Had problems getting my account up to where it should be. But I was wondering, is there something you can do on a paper trade account?
Yeah, I'll show you how to paper trade if you want. So yeah, it's simple and easy to follow. Let's see, you out there, Dean?
Yeah, how's it going?
Nice. Okay, great. Well, hey, it's great to have such a big crowd today. We'll do a quick little presentation, look at some of our recent trade alerts, and then open it up for Q&A. Let me just start off, the teaser I gave you guys today was that you only need 3 ETFs to generate retirement income for the rest of your life. Okay? So I just want to do a quick little presentation. We'll look at some of our trades.
Hey, Jason, can you mute everyone? The feedback's pretty bad.
I'll unmute everybody in a minute so that we can all talk together here. Okay, there we go. Chris,
there we go.
Superman, welcome. You just joined in. So yeah, I want to welcome everybody. Our goal here is to really simplify your life. We find investors come in and they're all over the place. They've got a bunch of risky assets that they have no business owning, especially going into retirement. And so I think you'll see the general theme of our product is going to be really three things. Number one, it's easy to do. Number two, it's predictable. You're going to know exactly when to do it and how to do it. And then three, it's relatively passive. Okay, so it's not going to take a lot of time. So you can actually enjoy your life. And our trades are extremely safe. So we're not going for growth. We're not trying to outperform some index. That's the last thing we want to do. Our goal is to take the best assets in the world and play it smart to generate safe income. And what I want to tell you guys is you can really boil it down to just 3 ETFs. Now we play a little bit more than that just to make it kind of fun. But really, you just need 3 ETFs for the rest of your life, and you're going to make more income than you know what to do with and stop losing big. Okay, and that's the SPY ETF, the TLT ETF. Those are the 2 big ones. And then we can use the gold market to help add a little extra edge and protection against inflation. And right now, there's not a lot of inflation, but the precious metal market is betting there will be, and that's why it's been flying up. So I just want to start off by showing you what our results have been and what the product looks like, how it operates. And then we'll jump into some of the real trades and see what kind of questions you have. And we'll also have Dean's experience to tell you how he came involved with our program as well. So the general recommendation that's going to make your life so easy is you should have half your assets in the SPY and half your assets in the TLT. And so the SPY is the S&P 500, represents the top 500 companies in America. It's better diversified than anything you could potentially buy on your own. So there's no way you could build a better portfolio of equities than the SPY. It's just you'd have to have like $10 million to even replicate what the SPY does for you. And you can do that with $300 share of the SPY. So that's what our big strategy revolves around, is owning the best asset. And I would argue the best asset in the world is the SPY ETF. It's the most highly traded stock. And it has something very unique that no other stock has, and that is 3 option expirations a week. Now, going into retirement, that's very handy. That means we can sell call options against the SPY for income, and then we can reinvest part of that credit that we collect to buy a put option. And when we do that, we can normalize our return, and we can sleep like a baby because we know we have a put option below our underlying asset. Now ask yourself, do you have a way to self-finance downside protection in your equity portfolio right now? Or are you at the whim of the market? And if you're at the whim of the market, you got to think twice about what you're doing with your assets. Is that really a safe play going into a US-China trade war right before what might be a brutal election as the global growth is slowing down? Do you really want to just be long equities, or do you want to try a strategy that protects the downside and makes consistent income from selling call options? And so that's our general theme, is that we want to own the best asset that's the most diversified and then not rely on the whims of the market to generate profits. Instead, we're going to use the option market to help normalize our profits and protect the downside. In our portfolio, we have 40% following the SPY, Monday, Wednesday, Friday. Trades at noon Eastern. My dad's got a funny saying. He says it takes him longer to take out the trash than it does to pull off our trade. And we'll look at what our trade looks like in a minute. But this is the only stock in the world where they have options expiring Monday, Wednesday, and Friday. So an analogy that's kind of like what we're doing, it's not exact, is think of that owning a little apartment in a skyscraper in New York City, and you use the Airbnb app to rent it out 3 times a week for income. That's what you can do with the SPY ETF that you can't do with any other stock in the world. So we'll come back to that in a little bit, but that's where in our portfolio we have 40% of the total assets. Okay. The next obvious place to put your capital is the TLT. Now, why the TLT? Well, where does all the money from the S&P 500 go in terms of tax revenue? It goes to the US government, goes to the bond market. Okay, so that's why it makes sense to put the other half of your capital in the bond market. This is what Ray Dalio has done to become the most successful hedge fund manager of all time. He's generated more profits for his clients than any other hedge fund manager. And the basic idea is a ratio of stocks to bonds. When one goes up, the other goes down. When one goes down, the other goes up. And the result is it makes it extremely hard to have a bad month. Now we're entering a period of time where it's become quite clear the central banks have to lower rates and start buying government debt. The governments have become so hungry for capital that they cannot collect enough taxes to do it. And so rather than raise taxes and create chaos, they're doing the sneaky tax. And that is just to print money. Nobody knows what's going on. That's the invisible tax. So that's why the gold market has been skyrocketing, because everybody can see what they have to do. The Fed's going to have to start buying US debt to protect the credit market. So that's why we recommend that you have a buy and hold position in gold. Now we spicing it up a little bit, but at the end of the day, just owning the GLD ETF is a great way to protect against inflation. And the last portfolio we offer is a Tuesday trade. If you don't want to trade 3 times a week, we have a very similar trade that only trades on Tuesday. It goes for a bigger return with a higher risk. And so far, that one's done very well. And we'll take a look at it. But here's our total return if you combine all the strategies together since we launched this service in December. This is right during the Christmas massacre. A lot of people lost a lot of money that month. Not all of our portfolios had a profit, but overall, if you combine them, we had a 1.1% return in December, 2.9 in January, 1.75 in February, 2.74 in March, 1.19 in April, 2.23 in May, 3.21 in June. July was our only losing month to date, -1, and August we're up 1.6 so far. Now you can see we're not trying to hit any kind of home run return in any given month. And that's because we're much more concerned about not losing money versus trying to make the biggest profit possible. Now, when we look at each individual portfolio individually, here's what it looks like. Now, during your free trial, you're getting to take our SPY trades for free. If you do end up upgrading, you'll get to try all the trade alerts during a 30-day bonus that we're offering right now. So you get to see every trade alert Monday through Friday. But the SPY trade has had good returns all on itself. And a lot of our members, that's all they want to do. They just want to trade the SPY. They like the safety. They like collecting that income 3 times a week. And for those members, they've been very happy. We had a 0.5% return in December, 3% in January, 2.6 in February, 1.5 in March, flat in April. We had 2 losing months, May and July. We lost 1%. June, we made 3.4. And August, we're only up 0.14. But we've been making some good profits this week. We've been expecting Trump to raise tariffs since June. And so he finally did in August, and now we're starting to benefit from being precautious. Now our Tuesday trade goes for a bigger return with more risk. And so it has had bigger ups and bigger downs. It's primarily been trading Apple as the single best stock to hold. Recently, it's switched over to silver, and that's because of the tariffs. Now, what's so special about Apple? It's the second largest position in the SPY ETF. So we know Apple has a huge demand just from the SPY ETF. It's Warren Buffett's #1 position. It's the #1 position in almost all hedge funds, pension funds, mutual funds. So it's a great company to do our same strategy with, but now we only have to trade once a week. So for some people, this makes a lot of sense. It does get a better yield selling call options, but it's a riskier asset. It's not a diversified group of 504 companies like the SPY. So it has its pros and its cons. Some of our members like to do all the trades because it's only 2 minutes a day. The main point is we give you the flexibility to get the income you need in retirement with the lifestyle that you want. So if you want to trade twice a week, you would do the Tuesday trade and the Thursday trade. You don't mind trading 3 times a week, you can do our Monday, Wednesday, Friday. So this portfolio took a hit in December, but quickly made it back in January. Jumped up to 3.5 in February, 3.9 in March, April 1.5, May and July it had a loss, just like in our SPY program, -1 and 0.2 and -1.3. June it had a 6% return, and August it's been doing very well. We actually took a hit on Apple right when those tariffs came out because that would directly impact Apple's production in China. Switched over to silver, and we've been making a lot of profit on that play. The bond portfolio, or here's our precious metal portfolio. Now again, this is only a small chunk of your assets. When you look at the big picture, there's something like $120 trillion of debt. That really represents the total monetary supply. The US stock market, something like $25 trillion in value. Gold market, you jump down to 6 trillion, and then you get down to something like Bitcoin, it's only 200 billion. And the only point is that these assets can be easily manipulated. So we don't want to put a lot of money in it, but when we see a trade war escalating, when we see all the central banks lowering their rates, printing capital, buying up government debt, inflating the monetary supply, that's a good reason to own gold. So we do have a buy and hold strategy that gets you gold, gets you some gold miners, some silver miners, and a little bit of Bitcoin. The return on that portfolio has had some huge swings up and down, but again, it's a small part of our total assets. 27% in December, -12 January, 21 in February, 10% in March, 26 in April, 60% return in May, 9.5 in June. July was just an ugly month all around, 11% loss. And so far, we're only up 2.5 in August. Now, this has been arguably the most carefree portfolio. Just been riding the TLT. It's only had 1 losing month in February, 2.15% return in December, 0.76 in January, -7.8 or 0.78 in February, 3.15 in March, 0.5% in April, and it's just been slowly bouncing around between 1 and 2%. One of our best months in August, 2.78. So those are the returns we've had. Every email we send out has a link to this track record, so you can click around and check it out all out in detail. This is the SPY trade track record. And so if you want to go audit the trades, you can do that at any time. Every email we send has access to it. I'll just give you a quick overview of how we organize the data. So we got the stock trades here in the purple area. If you scroll over, this is all the covered call writing. Now we use the covered call to do 2 things. Number 1, it helps guarantee we make some income every single trade, because we get to take a credit by selling a call option against our SPY shares. The second thing it does is it finances buying crash insurance. So we don't want to just outright own these assets. We want to have some downside protection. So over here is where all our closed long options are. And so it's been mostly just big losers on the puts, but you will see every once in a while those put options pay off. They protect the downside. So we had just in the month, in the last month, We had an 895% return on a put, protecting us from the downside. We had a 184% return from a put, and we had a 180% return on a put option on China. So these put options don't pay off that often, but when things get rocky, that's what really saves our butt and allows us to sleep like a baby at night. So we'll take a look at some recent trades in a little bit, but this is something you can go audit at any time. Now, I don't put the current trade in the track record. That way no one can steal our trades who's not a member. But every time we close the trade, I do put it in there and take a screenshot, and that's what we send out to our members. If you click one tab over, you can see our buy and hold portfolio. This one's actually up 200%, but I've diluted it by adding capital to it. So as we've seen the trade war really show its true colors, it's become quite clear that China has no intentions of ending the trade war. I think they really want to put the US into a recession. And so they're doing everything they can to aggravate Trump. And so far it's worked. It may be crashing their economy, but I think they feel like they can come out of it ahead. And so that's something we're closely tracking, and all the reason to own some gold. You can see our total history of trades, very few moves. It's a very slow moving portfolio. It gets you some gold, and it gets you some gold miners and silver miners. So we really like these three ETFs. You can make your life simple and just own GLD and get the same overall result. Now our Tuesday trade has the best return of our income strategies. So what's impressive about an income strategy is that it has the put option below the asset at all times. So that means we're selling a call to finance a put. It's limiting our upside return, but it's also limiting the maximum loss. It allows us to have a trade where we really don't care what's going to happen. We're either going to make the maximum profit or we're going to lose the maximum loss. And it's very defined and very small. So we're just trying to make a safe, consistent return over and over. This portfolio trades at Tuesday at noon, and that's it. It won't touch it outside of those dates, and it's had a very strong return. There's been periods where we had, right here, what you see are the top 8 companies that are held in the S&P 500. And so if you actually buy the actual top 8 instead of just the SPY in the same proportions that the SPY buys it, it's kind of like building your own SPY. Instead of having 504 companies, you have the top 8. And so we've done very well with a mix of these stocks doing the same concept. It allows you to trade less often and get a higher yield, essentially building your own miniature version of the SPY. Now the Thursday trade has been extremely boring. You can see we've only had 7 total buy and sells of the equity. There was 1 month where we rotated out of the TLT into Amazon and Google because they're trading at a 15% discount. And those companies don't trade at that discount for very long. They quickly rallied back towards their all-time highs. And so we went right back to the TLT. And we've actually missed out, even though this portfolio has a nice 13% return, with that strategy we've mentioned where we always have protection to the downside, but we're selling the call. And if I look at the covered call writing, all these negative ROIs on the short call, that's where our underlying asset went up and we had to give up some of the profit. So we lost about $2 of the potential profit on that trade. We lost about $4 of potential profit on that trade. This thing has just been going straight up with almost no drawdown all year. It's been a fun ride, and it seems like it's going to keep going even higher. So this has been an easy trade. And what's nice is when the SPY goes down, usually the TLT goes up. And when the TLT goes down, the SPY goes up. So if you're smart and you just diversify your assets like that, it makes your life so easy to generate safe, consistent returns. Now I'm going to go into some of our trades, but first I wanted to open it up to Dean to talk about his experience so far.
Thank you, Jason. So, folks, I'm going to apologize. My voice is a little scratchy, but I'm going to do my best here. So I guess I'll start off kind of by explaining about 10 years ago, I was playing the stock market, incredibly risky. I made a ton of money one year, and thought I was the smartest person on Wall Street, and started betting really heavy on extremely speculative things. I lost 6 figures in a week, and part of what I did is when I lost that money, not only was kind of the most really eye-opening and depressing points probably that I've been through, but it really kind of made me reflect and take a step back and say, okay, what's the safest way for me to invest? I have quite a bit of capital now. I want to preserve that capital. And if something ever goes really wrong in my life, I'm going to need some money to fall back on. And so it happened to be the very next day, actually. Warren Buffett was on TV with an open bet to the world that he bet the S&P 500 was going to outperform every single hedge fund manager out there over the next 10 years. And 12 hedge fund managers took the bet, at least that publicly admitted it. Warren Buffett said, "I'll pay you $1 million if you can beat the S&P 500. If not, you have to take me to lunch, and I'll donate the $1 million to charity of your choice." Long story short, every single person lost against Buffett. Okay, yeah, you might have this great quarter with one company that flies up 36%. You think that you're the smartest human on the planet. Well, guess what? 2 quarters later, they tank. They tank their they miss their guidance by 30%, and the stock goes down 50%. And all of a sudden, you went from being the smartest person in the room to being a complete idiot and hating yourself. And what I've really found about not only just becoming a more defensive and a more just risk adverse trader is the stress levels. Now I really enjoy investing. And the more defensive you turn your mindset, the better off you're going to be, and the more money you're going to have 10 years from now. Okay, and what I've learned is it's so much better not to be the aggressive speculator. And if you look at people like Warren Buffett, he does anything but that. If you look at guys like Ray Dalio, they do anything but be aggressive and stupid in the market. And I'll tell you what, if you have an account, you have over $100,000 and you're over 60 years old, you're retarded not to bet, not to be playing this market defensively. And I want you to also think about the fact that the market's up 450% since the bottom of the crash in 08. Okay, so if you're not playing, we got the trade war looming, we got currencies, dropping 22% like we just saw in Argentina in a 3-day period. You are absolutely crazy if you're not trading this market in a defensive manner. And I'll tell you what, it's just the level of stress and how much more you sleep at night is just it's absolutely mind-blowing. So I just encourage you, if you have a bunch of risky stocks, call me. Let's look at what you have that you shouldn't have. Let's get you out of some of those crappy instruments and get you defensive and consistent in the market. I guarantee you, it's after 3 months of it seems boring at first, but after 3 months and you see, hey, our win rate is massive. There's no massive loss days. You're gonna see life change in a positive manner. So that's what I gotta say. If you guys have any questions, please feel free to call me at any time. I'm happy to help.
Excellent. Thanks, Dean. So what I'll do now, guys, is take you through just a handful of trades just so you can see what it looks like. see how easy it is to follow, and then we'll open it up for Q&A. So trade alerts are very similar. We have Monday, Wednesday, Friday, we're trading the SPY. Tuesday is an alternative. If you don't want to trade 3 times a week, we've really created that as an alternative to the SPY. And then on Thursday, we're playing the US bond market. So that was the trade alert today. I'll just look at a few of the recent trade alerts so you can get an idea of how to read them and how to track them. And also someone said, hey, how do I paper trade this? I'll show you how to do that too. Because it can be a little bit confusing, and I want to clear that up for everyone. So at the top of the email, I like to start off by breaking down what happened from the previous trade to this trade. And one thing about how we've designed our product is that every trade is kind of like a mission impossible invitation. This invitation is going to self-destruct after reading. And all that means is that the whole trading idea is encapsulated in that trade alert. So there's no buildup of positions. I'm not going to ever tell you to hold one position from this trading period to the next. And here's why. I found that new people coming in, they don't want to see that you have a bunch of old trades, a bunch of old laundry sitting back there that they have to figure out what to do with. It also makes it very hard for me to support a large audience. We've quickly grown. We have at least 100 customers with at least $20 million of assets who trust these trade alerts to deliver what we promise. And so I have to make this extremely easy for everyone to follow. So the first thing we've done to make this easy to follow is made the trading day and time predictable. So you know exactly what day you're going to be trading, and you know it's at noon Eastern. Couldn't be any easier. You're going to get the email, the text message, and then we jump into a live stream. So if you have any questions, you click the video button right when your trade comes out, and I'm live for about an hour every day. Now that's just a chat box on YouTube where you can talk with me. We also do these webinars, which are a little more personal, and we can actually hear your audio. So that's in addition to that. Okay. So every trade alert is self-encapsulated. There's nothing that you're going to hang on to from the last trade alert. You don't have to worry about any of that. Everything is in the single trade alert. That makes the accounting very easy. Makes it so everybody gets the exact same results, whether you're new or you're old. There's no excuse. If you don't get the results I'm printing, it's because you didn't follow the instructions. And I know from personal experience, a lot of advisory services are very hard to get the results of the guru. Number one, you don't know when they're going to send out a trade alert. Number two, they're trading illiquid stocks. I mean, they're trading penny stocks, small cap stocks, who knows? They're trading option markets that are illiquid. So the second they put the alert out, that stock's already flying up. The second they say to sell it, it's already crashing. You end up buying high and selling low and losing money. Okay, so that's probably the most common complaint I've seen from doing this for a decade. And my experience started off actually representing all the gurus out there. And I found that they had a few problems. Number one, they were more concerned about trying to outperform the index, the S&P 500, than actually trying to just generate safe, consistent profits. And so in doing so, they took outlandish risks and they started trading very speculative products. And for most people who are following our alerts, that's the exact opposite of what they need in their life right now. So we're trading the most liquid products in the world, the SPY and the TLT. There's nothing more liquid in the world than the US S&P 500 and the US 20-year Treasury. Okay, so that's the first thing. Second thing is that we make it very easy for you to calculate your profit loss over the last trading period. So let's just look at this trade alert example that we just had come out today. Okay, so here was the original trade alert. This is telling you how to close it. We put pictures in it. It could not be easier, but here was the trade on 8/8, right at noon, screenshotted exactly how to fill it out. Okay, so here's all you got to do to paper trade this or to do your own accounting. Step one is we need to jot down what was the price of the asset when we entered the trade. Okay, so I didn't know TLT was going to fly up $7 this week. Clearly I didn't. I sold the 140 call. Okay, so TLT is trading at 138.99. Let's just round it off, say 139. You can see that right here. Does everybody see that? We're going to sell the August 16, 2019 140 call for a credit of 83 cents per share. So what does that mean? That means I'm willing to share my block of 100 shares of the TLT for a price of $140, which is $1 more than they're worth. Plus, I'll get to keep the 83 cents a share that I sold the option contract for. So from my point of view, I'm not trying to get growth. I'm not trying to hit home run returns. I'm not trying to be the top rated hedge fund. All I want to do is generate a safe, consistent income for the rest of my life. So sure, I would be happy to sell my shares for $1 profit plus 83 cents if it went higher. Why not? And on the other side, I'm happy to buy crash insurance. Who knows what could go wrong? That TLT falls to $100 tomorrow, doesn't matter because I was smart. I bought a put option to protect the downside. So what did I do? I took half of that credit that I collected for 83 cents and I bought crash insurance. Now, I would say that selling the call option is a lot like taking candy from a baby. Most of the time, these assets just don't fly up. So the call option buyers usually lose. And in our case, even if they win, we also win. And I would also argue that selling put options, which is what the big banks do, because they have plenty of capital to cover it if they need to. They probably want more TLT shares in their portfolio. So they're happy to say, okay, we will buy your shares for 137, no matter how low the TLT goes, if you pay us 41 cents a share right now. So you can see, I'm taking candy from a baby, only using half of that credit to buy downside protection. And so what does that do to my trade setup? It gives me a very defined risk and reward. So in this trade setup, the most I could win per 100 shares of the TLT was $1.52 a share, or 152 bucks. And because we focus on the big picture, the macro view, we know which direction to point our trade and to repeat that over and over and over again. And so if we can predict the interest rates, we'll have a good idea of what equities are going to do. And it makes life so simple. So you'll see it's really just as simple as understanding what the bond market's going to do and then paying attention to the earnings of US corporations. And we know whether to bet up or down on the bond market and the equities market. And so in this trade setup, the most we could make was 150 bucks, but the most we could lose was 147. Now this trade actually takes a little bit of that credit and it bought a bet on gold. So we did a bull call spread. We paid 49 cents to buy that spread. Now this was based on taking some of the profit from the covered call we sold on the TLT and just trying to double it. So we're not taking a whole lot of risk because we got this $50 for free from selling our call option. So you can see we're letting the option market finance all of our trades. So in this case, if GLD just stayed where it was, we would double that credit we received from selling the call option on the TLT. Well, let's see how it all worked out. The TLT traveled from 138.99 to an outstanding 146.42. You don't get moves like this in the TLT very often, folks. And so this is where that feeling of missing out comes in, and it happens all the time in our program. Sorry to say, but we have this feeling of missing out all the time. That's the cost of having absolute safety and consistency for generating retirement income. So let's look at what happened. We would have made $7, 7.4 if we were just holding the TLT. But this is not a growth strategy. We're not 40, 30, 20 years old. We can't afford to have big swings in our account. What we need is consistent, reliable income week after week with almost no risk of taking a big hit at any time. Now, simply by having half our assets in the SPY and half our assets in the TLT, we've already taken a good step in being defensive and creating what Ray Dalio would call a weather-proof portfolio. So what happened? Our option caller started off by paying us 43 cents. Now, let me show you that so you can see it. See that credit of 43 cents? That's what we collected when we put on what's called a collar. To get out of it, we had to pay $6.50. So I'll show you that. There we are. We paid $6.50 to close out that trade. Okay, so we actually lost on the collar, which is okay, because we made 743 on the TLT. We lost 606. And guess what? Our bull call spread was a winner. We paid 49 cents to get in. We collected 93 cents to get out. And we can see the screenshot right here. We collected 93 cents today to close out that bull call spread. So what's the net return? So again, you're going to have to track a handful of things, but we want to know what happened to the underlying asset. It went up, generated a profit of $7.43. We want to know what happened to the options when we lost $6 on that. What happened to our GLD play? We made 44 cents. That was a net profit of $1.81 per share week over week, or a 1.3% gain. Now, I don't think we'll make that return every week, but if we did, that would be $9,412 of income from a $14,000 investment to own 100 shares of the TLT. So you can see how that adds up. Today's trade was very similar. In fact, we're becoming a little more bullish on gold, but here's the setup. We sold the call, we bought the put. And then we took a little of that credit, and today we bought a call option on the largest gold mining company in the world, Newmont Gold Corp. Okay, so this will be a very repetitive trade, as we expect the Fed has to lower rates probably close to zero and start buying up government debt. And that's because the US government is so hungry for money that it can't possibly collect enough taxes to pay for it. And that's been the case for the last decade, and it's getting worse and worse. And in fact, if the government stopped creating debt, our GDP would crash. So in the short term, this is actually good news for equities that the government does want to spend so much money. Okay, so that's one trade. Let's take a look. A lot of people want to know, how do you make money if stocks go down? So I'm going to close out these. I like to give myself nicknames. Like I said, we've got about 100 members, a little bit over that, probably about $20 million following our trades. People really trust that we're going to protect their capital. So I call myself Debbie the Downer, call myself Negative Nancy, Paranoid Pete. I called my audience the Peanut Gallery because they're always complaining how precautious I am. They hate it when the SPY goes up and our crash insurance loses money, but the rest of the play made money. We're giving some of our profits up. And until recently, we really saved their butt by playing it safe, by being a little bit paranoid. And so this week's a great example of how you can actually safely make money from an asset going down in value. So we went from being very bullish equities. Let's go back to June. I was worried that Trump is going to raise the tariffs while we're out in Hawaii in July, 4th of July weekend. I know that he wants to raise tariffs. He wants to make a better trade deal with China. He wants to get them to stop stealing and flooding our market with subsidies that makes it too hard for Americans to compete. He wants to bring back the manufacturing. All well, all great stuff for America, but when's he going to do it? That's what I was worried about. He's got the election in November of 2020. The Chinese haven't given us anything. They haven't bought any agricultural products. They won't agree to any kind of enforcement mechanisms. And it's become quite clear that they don't want a trade deal. In fact, I think they want Trump out of office, and they want to create a worldwide recession. They think they can come out as the #1 superpower in the world. And so it's interesting to follow. But in this case, Trump finally came out a month after I was expecting it, and he said, we're raising tariffs, 10% on the remaining $350 billion. So we were ready. I've been ready since June for this. And let's see how some of these trades played out, where we were able to safely profit from a downward move in the SPY. Now, if you've ever tried to play the downside, it's very hard to make money betting down. If you buy a put option and the market goes a little bit higher, that put option is going to lose all its value so quickly. And on the other side, when you do buy a put option and it does go up, if you don't sell it at the right time, it usually pops right back up and you lose all that value. So trying to buy put options to short the market's too hard. Don't recommend that for anyone. Here's the strategy to safely generate profits in a downward market. So let me just pull up the last 3 SPY trades we did. All right, so here is the trade we closed out yesterday. During this trading period, the SPY ETF traveled from 289.05 to 286.06 for a loss of $2.99 on the SPY. But with our option caller, we went from collecting a credit of $1.61 to collecting an additional credit of $1.97. This generated a profit of 59 cents a share. Now, if we do that 3 times a week, 52 weeks a year, that's $9,204 a year of income per $30,000 invested to have 100 shares of the SPY. Now, you gotta be wondering, how on earth can you make money from the SPY going down with the caller trade? Well, let's take a look at the exact trade. I'll show you how it worked out. In fact, we've been pulling off these nice returns consistently on this setup. So here was the trade. So we can see at the time of placing this trade on 8/12, the SPY was at 289.08. We sold a call option for 287. So you got to really quickly say, wait a minute, why would we sell a call option agreeing to sell our shares for less than they're worth? If it's trading at 289, why would I want to sell my shares for 287? That's a $2.08 loss. Well, good news. The guy buying that call option was willing to pay a premium greater than that $2 loss. We collected $3.38 to sell him that call option. It's called an in-the-money call option. Now, that in itself will not make money if the SPY went down. We had to take part of that credit and buy a in-the-money put. So we bought that $288.50. I guess that's at the money. And so here was the setup. We needed the SPY to travel a little bit lower to that 287 level. And if it did, we could make a profit of $106. Now on the other side, if the SPY rocketed higher, didn't matter how high the SPY went, the most we could lose is $43.50. Okay, so it's very easy to safely make money on the downside by simply putting the call option below the trading price and the put option above the call. So let's look at the exact trade. We'll look at the screenshot so you can see this is what indeed happened. So here's the trade, trading at 289.05 when we sold the 287 call for $3.30, and we bought the 288.50 put for $1.80. So what did it cost to get out? So we can see it went from 289 price to 286. That's a $3 loss. But on the caller, we collected $1.61 credit getting in. And because that put option flew up in value and our short call lost value, we're able to collect an additional $1.97 on the exit. And guess what? We did the same trade yesterday, and right now that one's at its maximum profit as well. This one needs it to be below 285. Collected a 69-cent credit. We'll see what we come out with on Friday. So you can see we can safely generate profits in an up or down market by simply adjusting the caller. And no matter what, we know for a fact, no matter what happens, we're not going to get rich, but we're not going to get poor from any given trading period. And so I like to call these atomic bomb proof trade alerts. Okay? You can sleep like a baby and not worry about what on earth is going to be tweeted out at midnight from Trump. We don't have to worry about the Chinese invading Hong Kong. We don't have to worry about Deutsche Bank going bankrupt. We don't have to worry about $13 trillion of negative debt. We put on the asset, we put on the option caller, we get the big idea correct, we do the same boring repetitive trade over and over again, and it works very well. So let's look at this trade. So this is from Friday to Monday. So let's look at the summary. Okay, so from Friday to Monday, the SPY went from 290.18 to 289.23. We call it bag holders. Bag holders who are just long the stock lost 95 cents. We're not a bag holder. We take advantage of the option market. We collected 44 cents to put the trade on, and we collected an additional $1.02 to get out. So we created a $1.46 profit from the options, and we only lost 95 cents from the SPY. That's 51 cents a share. That's $51 for every 100 shares. Well, guess what? If you do that 3 times a week, 52 weeks a year, that really adds up. That's $8,424 of income. So let's just see what the real trade looked like. Okay, so we jumped into this trade when the SPY was at 290.20. We agreed to sell our shares for a $1.20 loss because the call option buyer was willing to pay $2.50. That's about $1.30 if the market went higher that we would make. But of course, we wouldn't profit if the market went higher because we bought an expensive put option. So we collected $2.50 from selling the call option, and then we purchased a $2 put option. So you can see the strike of the call was below the trading price, and the strike of the put was above. So this created a graph that gave us a maximum profit of $1.20 if the SPY had dropped a little bit lower. And in the worst case scenario, we'd lose 80 bucks. Okay, so that's how we ended up having the SPY drop $1 or 95 cents, and we were able to get out of it for $1.46. In fact, I underreported that one. We got $1.61. Now our Tuesday trade is the same thing, same idea. You're going to do it once a week. Currently, we're playing the silver market, and this has had some nice returns. Now, the silver ETF is only 15 bucks. Our last trade pulled in a 14-cent profit, and so that's about a 1% return week over week as well. All right, guys, I'm going to go ahead and open this up to Q&A, see what kind of questions you have. Hopefully you can see this is pretty straightforward. Going to allow everyone to talk. All right, guys, I've unmuted everyone. If you have questions, you can speak out loud or you can use the chat box. I would love to know your questions, your concerns, and of course, if you're ready to upgrade and start getting all of our trades, you'll get, normally it's $2,000 a year for our SPY trades. We have a deal where you can get that 50% off. And you'll also get a 30-day free bonus to have the Tuesday, Thursday trade. That way you can see what makes the most sense for your lifestyle, whether you want to trade twice a week, 3 times a week, that's up to you. What questions we have out there, guys? And there's no dumb questions. It's really, I'm sure if you have a question, someone else is thinking the same thing. What about you, Ernest? What questions do you have? Ernest has been on and off following us since about February. So you've probably seen this more than anyone else on the webinar.
Yeah, I've seen it enough that I don't have any questions.
Yeah, pretty straightforward, huh?
This is Theodore. I have a question. I notice on most of the trades, you can you hold 1 second, please?
Here's Selena. Selena said call her because she's selling that too.
Selling what?
And that's Byron now. That's a brother. She said call her now.
I'm on the web right now.
Okay, so I was saying, I noticed on most of the trades you have the collar, but you're taking the profit and you're buying something else. Why not just take the profit from the collar and leave it at that?
Yeah, so the SPY trade is what we typically give out during our free, well, it is what we give out during our free trial. And so for that one, I do like to keep it really simple, as little work as possible. So we're just doing the SPY with the collar, and then that's it. On the Tuesday, Thursday trade, usually we can take a trading idea and we can correlate it to something. So, for example, if the TLT is going higher, that means that rates are going lower and that most likely we're headed towards a global slowdown, which means the central banks are going to have to print money. So the correlation to the bond market is that if bonds are going up, gold should go up at a faster pace. So that's why I like to try to take a safe income from the TLT and then use that credit that we've essentially gotten for free. You know, I'm happy to own the TLT. I'm not happy to own a bunch of gold because it's so much easier to manipulate. The TLT, I know for a fact, the US government and the central bank, the Federal Reserve, is not going to let that bond market get out of control. Can you imagine what would happen if the bond market got out of control? The entire financial system would collapse. So my idea is that, hey, I will own with my real capital the safest asset. That's the SPY and the TLT. But if I can take free money out of the option market and then use that to speculate on a correlated trade, I can juice up my returns, get a little extra profit. So you'll see on the Tuesday, Thursday trade, I'm taking some of the credit and then I'm correlating it to get a bigger return. So I'm essentially trying to get free money out of the option market and take that free money and then correlate it to the asset. So right now, the silver play on Tuesday is taking a little bit of that profit that we're pulling out of the call options, and we're buying put options on China because I think China is going to collapse, and that's going to create a big run up in silver. So they're correlated. Now, I don't know when exactly that's going to happen. I don't have a crystal ball, but I know the big picture. I know that China has created more debt in the last decade than the US has created in the last half century. That's absolutely insane. So my thought is that the banks are going to try to protect their governments and their bond markets by printing money until they can't. That's going to create inflation. That's going to create a run up in silver and eventually a collapse in the FXI ETF. But timing is so hard. Trying to time that is so hard. If you go out with a big bet, you might lose a lot. Our strategy is not to do that. Let's take the smart idea. We like silver for the Tuesday play. Let's sell the call option, buy the put. If the China trade war were to de-escalate, silver could fall really fast. So I don't want to just be long silver with a big chunk of my money. That's what the option caller does to protect me. But if this current trend continues, then I can make good money betting down on China and up on silver. So that's what our Tuesday trade will do probably for the next 12 to 36 months, as I think this trade war is just getting started. It's not about to end, it's just getting started. Same idea with the bond market. On Thursdays, we're taking the TLT, and then we're betting that if the TLT is gonna go up, gold's gonna go up even faster. So we're owning the safer asset, and then we're using some of the credit we pull out of the option market to just get a little extra edge, a safe way to boost our profits. Now the SPY program, we're not doing that at all. I really want it to just be self-contained within that. So that's our, that's our bread and butter play. That's how we get people to trust our company. And that's how we really prove to our audience, these guys really know what they're doing. So I make that play as easy to follow and as simple to follow as possible. That way you come in, you can do the trades. A lot of people have said they've made more money in the first week of doing the SPY trades than our whole program cost. So you can't beat that. Now on Tuesday, Thursday, do we make it a little more advanced? Yeah, but not much. Does that answer your question?
It does, but I was just wondering though, if since you already guaranteed that profit, why not just save it rather than opening up to more risk with the second?
Yeah, sure. So if you wanted to not do the little bonus play at the bottom, you could skip that.
Okay, good. Unfortunately, I have to run now, but it was a great webinar. I'll be back.
Thank you, Theodore.
Thanks.
Thank you, Theodore. All right, what other questions we got out there, guys? Let's see, I see a few new people in here. Victor Pisoros, do you have your audio? I guess you got your mic muted. Kate Mian, welcome to the webinar. FR, anyone else have any questions out there?
Here. I'm just doing something.
What's that, Victor?
I'm just listening to the cast. I
Oh,
don't
okay.
have questions. They just came in the middle, but I see what you're doing. So, but I don't really.
Any questions or concerns?
Well, I can't really see any graphs or anything, so it's hard for me to know exactly. Plus, I'm sort of listening to it and working at the same time, so it's hard for me to know. But I understand that yours is a service that's going to try to get trade alerts, you know, that kind of thing. So that makes sense to me. I don't know if I'd like to watch what you do rather than pay a lot of money and not know what I'm doing and not be able to do it. So that kind of thing.
Sure. Well, yeah, I mean, we try to make it easy. So every trade has exactly how to fill it out. And every trade alert is also self-encapsulated. All that means is we're going to completely exit the trade on the trading period and then completely reopen it. So you don't have to worry about anything that's happened in the past. Just follow that trade. It's good to go. Have you ever traded options before?
Not actively. I've just been watching it, really. Just watching it, because it's one thing to watch it, it's another thing to do it. That's for sure.
Yeah.
Yeah. Have you tried paper trades?
Right now?
Have I tried what?
The paper trades. That way you can replicate exactly what we're doing without using real money. It's the best way possible to test out what we're doing without using real capital.
Right, and I understand that Ameritrade, which is who I have, does have a paper trading aspect, but my thing is I'm more at the point where I'm sort of trying to figure out how to understand it first before I actually do the mechanical things and carving out the time, because that's my problem, is that I have all these different competing things to do. And it's never going to be that easy like you think it's going to be. And it seemed like it would be in the beginning, but then when you're actually trying to do it, it doesn't work right. It never comes together like you think it's going to.
Sure.
So, Victor, this is probably the most important part about our whole product. We will not touch the trade outside of the trading period. So, for example, the Thursday play. Well, let me ask you this. Do you own equities?
Yes.
Okay. Do you own bonds?
Only in my pension fund.
Okay.
I
Now,
don't know any bonds.
do you feel like your equities are well diversified?
No, they're not.
Okay. So first recommendation for you is why don't you own the SPY?
Well, because of what the market is doing right now. And I've been expecting, I'm one of these contrarian people. I've been expecting that for a long time.
Okay, but you're saying that we're making money on the downside, right?
Well, no, I didn't see that. But
Well,
I mean,
let me
that
show
could
you
be
real quick. So look at this. So first of all, if you own equities, you've been getting hammered. I'm sure that doesn't feel good.
right.
Look
But I don't have
at this. We've been making money all week from the SPY going down.
How much you have invested?
Okay, so yeah, we're not trying to make a lot or lose a lot in any given trade. So let's just, I think you got in a little late, but look at this. Here's the last 3 trades on the SPY. So first of all, SPY will better diversify your equity. You already own equities, right? But I'm betting you don't have any downside protection. So that's
Right.
crazy right away.
Right, exactly. No
So the
doubt.
second you join our program, you're going to sell all your equities and load up on the SPY and then start following these trades. You're not going to lose money. You're not going to have a day where you lose 3%. It won't happen because we always have puts. But look at, so here's what, the second Trump came, I was really bullish on stocks because I thought Trump was going to delay the tariffs till 2020. All in June and July, I was sitting there super paranoid. He's going to raise the tariffs. Seemed like he wasn't going to do it. He says they're not going to do it. Says Chinese are going to buy farm products. Everything was great. Well, then he comes out upset. They didn't buy shit and raising the tariffs. So immediately we said, all right, time to flip the collar. Here's what that means.
Right.
Here's how you safely make money on the downside. This is your setup right here. Can you see that?
I can see it, yeah.
Okay. So this is the easy and safe way to profit from a down move in equities. So if you've been following us since Friday, you didn't make a ton of money, but you're making the same boring return we're making on the upside as well. So typically this will be reversed. We'll be expecting the SPY to go up. But the second he came out with the tariffs, we flipped it. We flipped the trade. So we sell the 289 call. Now look at what price do you see the SPY's at right here? The last trading price.
290s. Yeah.
290. So if we think the SPY is going to go lower, this is how easy it is. We sell the 289 call. That's $1 less than it's worth. Why would we agree to sell our shares for 289? Because a foolish call option buyer is willing to pay 242. Okay, and then what do we do with that 242? We buy a put. Puts make money on the way down. Okay.
Yeah.
So normally I will sell the 291 call and buy the 289 put if I think it's going up. So here's your risk graph. The worst thing that could possibly happen with this trade setup is we would lose $80, and that's against 30 grand of equity. Okay, so the most you could lose in this trade would be if the market went up, you could lose 80 bucks, 80 cents a share. Shares are worth about $2.95 right now. Now, best case, the most money we can make is $1.20 a share. Okay, so
Right.
SPY crashed. We made some good money. Here's the summary of what happened. The SPY went from 290 to 289 for a loss of 95 cents. That's what we call bag holders. That's what you are right now. You're an equity bag holder. So you enjoy all the upside, but you also have all the pain of the downside. The option caller started off with a 44-cent credit, and then at the end paid another $1.02. So we made $1.46 when the SPY lost 95 cents. So we made 51 cents a share. That's $51 per position for the SPY. That doesn't seem like a lot, but what if we do that 3 times a week?
Right. No, I agree.
It adds up.
And
It
it's,
really adds up.
yeah, and that's not that much money that's being invested either. So there's a lot more than that.
Most of our clients trade at least 100,000. A lot of them are millionaires. And so people come to us because we can protect capital and squeak out a consistent return after month.
Right. How many?
We're not going to outperform the market. We're not going to compete with all these crazy advisors who are trying to, hit huge gains or play this or that. We're not trying to predict something wild's going to happen that hasn't happened. What we're really doing is we're going with the flow of the market. We're paying attention to potential earthquakes like tariffs, and that's it. And we put half our portfolio in stocks, half our portfolio in bonds. That alone makes it very hard to lose.
Right. Well, I mean, and this is a certain liquid amount. Like, say I have $5,000 that's liquid, but I have to. Then your service is like more or less like $1,000. I might break up a little bit because I'm moving in a basement area. But so I kind of want to know if it's worthwhile. And then the other thing is, you're mostly operating the daytime for any kind of questions, right? Or can you leave them on some sort of message board?
So our trade is at noon Eastern, like clockwork, same day, same time.
Right.
Yeah, and then
Right.
I'm available for an hour after, right after the trade goes out, just so you can.
Right. So you just set that time aside, some of it anyway, like a few minutes a day.
It takes
around-
2 minutes. It does not take, if you spend more than 2 minutes to do these trades, maybe you're looking at some charts, I don't know, maybe you forgot your password to log into your broker, but
No, but I mean, well, no, it's going to take me more than 2 minutes, trust me, because I'm just not there yet. And then just getting it set up and all that. But I mean, it's like you're at least accessible, easily accessible. So that's a good thing.
yeah. How much capital do you have? How much did you lose this week in your stock portfolio?
Well, that's another thing. I didn't look. I had some, I don't look that often. And I didn't really look at them because I had gold stocks and things like that. But I invested in some commodities through a broker, and it was going really well for a while, like super well, like doubling the money. And then the bottoms fell out, even though there were, it was options and futures, and even though there were supposedly protections, the broker was very sort of unable to really explain fully what the movements meant in terms of how the dollars were gained, one way or the other. And so when the bottom fell out, I think it was soybeans, and it was all the trade stuff because China wasn't buying the things that they were supposed to buy, and the harvests are not supposed to be good. There was this issue where we made a whole mess of money, but then it was never realized. So now I don't know if with that money. I mean, I lost a little bit of money, not a lot of money, but then I kind of want to know if I should take that money.
Instead of worrying about how much money you'll make from our program, you might want to stop and think, how much money am I not going to lose because I get some sound advice? You probably lost more money this week than the whole cost of our program just because you didn't have good advice.
Huh?
You probably lost more money this week from bad advice than our entire product costs. And meanwhile, we're making money.
That's definitely true. No, I agree. That's definitely true.
But you don't have Victor, it's
that money. It's like it's in there somewhere, and I'm not always doing anything with it. So.
I don't think you even know how much money you lost. That's what's a scary thing.
Yeah, and Victor, this is Dean. I can't tell you how many people that call me after they just lost $30,000 and say, okay, I want to get defensive, Dean. Let's get started. And I don't understand. Like, people have to lose the 30 grand before they call us. It blows my mind. But I mean, it's just like the doctor, right? You don't go until you're sick, and I think that's when people call us too. It's really funny.
So it's important to realize, Victor, our return goal is around 1% to 2% a month. So that's why our worst month is we lost 1%. So we're not
2% a month is good.
We're not making anybody rich over here, but we're sure.
Yeah, but I mean, 2% a month is good.
We're safely growing the portfolio.
Yeah, and I see it on the thing. I see it on the thing.
So yeah, that's why very large portfolios love our product, because they know they can count on safety and just slow grind, slow profits, safe profits. What's the easiest, safest way to make money in the stock and bond market?
Right, and plus you're making it either way, one or the other. How do you guys come around your prospective movement? You're just taking an educated guess, right?
Yeah. So okay. So there's really just two things we have to pay. This whole product really revolves around 3 ETFs. Okay. The first ETF is the SPY. That's the U.S. equity S&P 500. Okay.
Yeah.
That one is extremely news sensitive to the tariffs. Okay. So we're paying close attention to the U.S.-China trade war. We're paying close attention to the value of the dollar against other currencies, which is extremely strong. And we're paying attention to the earnings of the top companies. So It's really just these 8 companies right here: Microsoft, Apple, Facebook, Intel, Cisco, Comcast, Bank of America, Wells Fargo. Okay, so the U.S. stock market's very strong, and even though we're having a little downturn right now, unless this trend war escalates, I think we're going to have a huge rally. Now, I've been betting down this week, but I'm not going to be betting down for much longer, and we're doing it in a safe way. We can't win or lose a lot.
Right.
The bond market has been very easy to predict. Okay, the U.S. government is creating more debt than it can collect in tax revenue. Okay, so either the government defaults, government cuts off all the welfare programs, or the central bank has to lower rates and print money. Okay, so
Yeah, well,
that's
that's
pretty easy to predict. We know that's going up for now until inflation comes.
I agree.
Okay, and then the extra edge is to own a little gold. Okay, so we got this simplified. You're going to own the SPY, the TLT, and the GLD. That's it. You need to get rid of everything else, make your life simple, and you're going to have a lot better result. And this is not just something that's short term. This is a strategy we can play out for decades to come. It's very simple. It's very repetitive. Start watching our daily video. You'll see all the content that I'm looking at to just try to, all we got to do is predict 2 things: our stocks going up or down, and our bonds going up or down. If you get that general picture right, and we take advantage of the option market, you can make a nice, safe 1% to 2% return a month consistently.
Right. How many clients do you have?
We launched in December, and we have about 120 members. I'd say we have about $20 million of assets following our trades.
Wow. I mean, that's not small. It's not big, but it's not small. So that's good. Good for you.
So yeah, you know, we've really had to impress people with the trade alerts, because it's not like we have some 10-year track record. Now, I've represented all the gurus out there for the last 10 years. And that's when I realized, hey, these guys do not understand what these clients really need. These clients are not at a growth stage in their life. They're at a capital preservation stage. They need to play it safe. They need to go for the easy money, and they need to have downside protection. So
right, those are good.
We have a put option below the TLT, and we have a put option below the SPY at all times. So it's impossible for us to lose much. Now, does that take away some of the profits? Sure, it does.
Well, I mean, yeah.
Imagine you only have 3 ETFs to worry about for the rest of your life, and you can make 1% a month. It's a little bit better than what you're doing right now, right?
Yeah, no, I agree. I agree. I mean, if it helps me pay my credit card bill, that's a good thing.
Yeah.
That's a good thing. So, and that's what I was hoping to do with this, the trades with the options that we're doing, the commodities, was I just wanted some of extra money. It was working for a little while, but I was never able to capture that.
Well, we're going into a global recession. Demand for commodities is going to plummet. So that's a crazy investment strategy right there.
Well, I mean, the thing is, though, is the harvests are bad. They're going to be bad. They're not going to be what they were. And China's having all kinds of problems, but then we're not, you know, we're not dealing with China at this point. China's going to go.
So that's a young man's game right there. That's a high risk, high return, speculative strategy. And there's nothing wrong with that, but you know, you got to ask yourself, are you at the point in your life where you can afford to lose 5, 10, 20% of your capital?
Right.
That's not where you're at in your life. You should be doing that kind of strategy. You know, why not just own the S&P 500 with half your portfolio and own the US bond market with the other half, buy a put option right below it. So no matter what happens, atomic bombs could go off tomorrow. We wouldn't give a shit because we got put options. And meanwhile, we're taking candy from a baby by selling call options against our asset. And that's how we get consistent returns.
I have a question.
Yeah.
So you guys, you have all the trades there that are mapped out, and all you do is just copy them? That's what I do, is just copy those trades?
Yeah, you do the exact trade verbatim. You know exactly when it's coming out. So the prices are extremely close to what you'll get. We're trading, there's nothing more liquid in the world than the SPY ETF. It's by far times 10 the most traded stock in the world. There's nothing even close. And then the bond market obviously is about five times larger than the stock market.
Yeah.
Now the TLT just represents the bond market, so there's not as much trading volume in the TLT, but of course there's much more trading volume in the bond market than the stock market. So yeah, this is basically what Ray Dalio. Have you ever heard of Ray Dalio?
Yep.
Bridgewater Associates.
Yep.
Okay, so he's made more money than anyone else in terms of profits for hedge funds in all of history. Guess what he does? Half bonds, half stocks. He goes back and forth between. When one goes down, the other goes up. Now he does it more advanced. He likes to do it in the entire world instead of just in America. But he's managing $122 billion.
Right.
Our clients, if we can make 1% a month with 3 ETFs for the rest of your life, you're going to do well, and you're going to simplify your investment strategy. Even though it's only 2 ETFs that have the bulk of your capital, it represents, the SPY represents 504 companies. Well, the bond market represents the taxable income of every company in America, plus all 350 million citizens.
Right. No,
So
and I
it's
see, I understand.
diversified just with 2 simple securities.
Right, and we're not wedded to any of the bonds either, so that always helps.
Yeah, and we're not even trying to. We're really trying to make money from the option market by taking advantage of people who want to bet. So there's people who want to bet that the SPY is going to go high and the TLT is going to go high, and they're willing to buy call options. So that's where we really make the consistent, easy money, is selling those call options.
Right, and I get that part. And when I tried to do it, I didn't do so well at it. But that was because I picked, you want to buy covered calls, and it's not.
I would call up Ameritrade, tell them, just read them the trade, until you feel confident. It's a simple trade.
Yeah.
And Victor, that's what you pay the broker for, right? You literally just read them all the steps of the trade, ask them what buttons to press, and maybe a couple times on paper first, get comfortable, and then start making your membership fee back.
Yeah.
Well, here, let me show you how you open and close these trades. So here's an example. So you sell to open August 12, 2019, 289 call, and you buy to open the August 12, 2019, 291 put.
Yeah.
Okay, that's how we open it. Here's how we close it.
Hold on a second, I lost you a little bit here. Unfortunately, the technological issue. Oh boy.
Oh, you lost the screen? No worries, that happens.
Yeah, I lost the screen.
Yeah, I'll show you how easy it is to do these trades, though.
I wish I was online, but my thing is, I'm at work, and I was just dealing with some other people, and I stepped away to do this. And I do really like this, and I'm definitely going to consider it. Let me see if I can get back to this. I should have been online. It's easier for me to do stuff in the evening than it is to do it during the day, just simply because of the distraction level of my work and the different people that I have to deal with. So it makes it harder.
Well, so that's a good point. So what's important here is that, number one, the trade alert is
there it is.
the same day and time. like religion. There's no exception. There will never ever be a trade outside of our time period. So
you're
Monday, Wednesday, Friday at noon. But if that's too much work, you might want to do
no, that would be that. Huh? Say that again. If it's too much work, what?
So we most of our clients prefer the SPY. You know, most of our clients have a lot of capital, so they want safety. They're much more concerned about safety than return. So most people like that SPY trade.
Right.
It has the most safety because we can do the covered call with the put and adjust the strikes as the market goes up or down 3 times a week.
Right.
Monday, Wednesday, Friday.
And I could do it once I got into the hang of it. I mean, I'm not a brain surgeon, but I'm not a dummy. It's just dealing with the other things. So that kind of thing.
It sounds like your problem is you have too many different things going on. You need to consolidate your effort into something simple.
Right.
Considering you got a job, you don't have time to be swing trading and day trading and worrying about whether some commodities brokers ripped you off or not.
Well, and the other thing is that, yeah, that's true. And then the other thing is that's true. And then the if your track record, I mean, everybody, you come into every one of these things optimistically, and then it ends up not panning out. I mean, your market has a lot of participants in it. So, but then the idea is to make it streamlined and make it competitively priced. And it's like a lot of people, I mean, I've wasted so much money because it's not always practical to do the basic thing.
Well, yeah, but see, Victor, we're not trading corn futures or soybean futures or some crazy shit like that. This is the SPY ETF. This trades $16 billion a day. I'm not sure how much money that is a minute, but I think it's trading something like $10 million a minute. So yeah, and our audience has been buying and holding the SPY. So really all they got to do is get in and out of the option.
Right.
So you see the screen right now?
Yeah.
Okay, so let me just show you. It takes 2 minutes. So you got to own 100 shares of the SPY. And then here's the trade. You sell to open the call. Now, do you know what that means when you sell a call option?
Yes.
Okay, so all that means is whatever the strike is, we'll sell our shares for that strike, and we're going to take in a credit. Okay, so it's as simple as that. Now, what does a put option mean if we buy a put option?
It's betting on it going down. The price of the option and the stock are going down.
Yeah, but really what that means is we have the right to sell our shares for that price. So the top part is what we're willing to sell our shares for, plus the credit. The bottom is what we're willing to get paid for our shares minus the debit. Okay, because we sold the call, so we get to keep the credit. We bought the put, so we do not get to keep the debit.
Right.
Okay, so we sell to open a call, and we buy to open a put. Now here's how we close it. So sell to open the call, you have to buy to close the call. So if we sell, we take a credit. If we buy to close, we pay a debit. So in this case, we collected $250, and to get out of it, we had to pay back $90. So we made $1.60 on that part of the trade. Now the put option protects us to the downside. That's a big banker who does that trade. He's willing to buy our shares for $291, no matter how low the SPY goes. Now the catch is he's going to keep our $2. So let's see what happened. Well, we paid $2 for that put option. We sold it for $1.92. So we ended up taking a credit of 44 cents to start off the trade. And to get out of it, we collected $1. Now let me ask you this. What do you think we did the second we closed out that option collar? We put on a brand new collar. Look, we did it right away. We don't ever own the SPY without the collar. There's like literally a minute where you're not going to have the protection. So the second we get out of the last collar, we're going to put on a brand new collar. So once again, we said, all right, we'll sell our call option, 287, for a credit of 330. Now that's a big credit. Why are we getting such a big credit? It's because we're agreeing to sell it for a loss, 287. So when we did this trade, it was trading at 289. Well, we said, hey, we'll sell it for $2 less, 287. But the call option buyer had to pay 336 for that. So stocks go up, we still make $1.30 on that part of the trade. Now, of course, this was a downward bet. This was just on the 12th. So we paid $1.80 for the right to sell our shares for $288.50. Okay, so this is how you make money safely predicting down on the SPY. I rarely like to bet down on the SPY, especially in this certain current circumstances, but I will when I think it's going to go down.
Are those monthly options? What are they? Weekly? What?
Monday. Oh, so that's what's cool about the SPY. That's why this strategy is so brilliant. The SPY is the only security in the world that has an expiration 3 times a week. Monday, Wednesday, Friday. So we can collect income on the SPY 3 times a week. And I'm telling you, this trade does not take more than 2 minutes. Under no circumstances will you trade it outside of the trading period. Monday at noon, Wednesday at noon, Friday at noon. These trades are atomic bomb proof because, look, the SPY could collapse $100 tomorrow. We wouldn't care. We bought the put option. We have the right to sell our shares for $291.
Right.
Okay, so you're not going to get rich with all this protection, but you're sure as hell not going to get poor. And that's the whole point.
Right. Well, I mean, it's the thing is it's a good education too, and I'm still a little hazy on some of it, but I mean, there's a mechanical sort of, you go through the motion to get from point A to point B that I like with this.
Yeah, so let's just look at the trades, just so you kind of see the motion in the ocean, I will say. So here we are on the 9th. So we sell to open a call. Let's just not even worry about the expiration or the strike, okay? Because this part's repetitive. We own 100 shares of SPY. We have to sell to open the call, buy to open the put. That puts the collar around your SPY. You know, think about your dog.
Yeah,
you put a collar on your dog, he's not going anywhere.
Yeah, I get
Okay,
that.
now how do we take the collar off? Because we want to collect our profit. Buy to close. So remember, we sold to open the call. We bought to open the put. To get the collar off, we buy to close the call, and we sell to close the put. But guess what? We don't want our dog running loose. We got to put another collar on him. So then immediately after we collect whatever money we made, in this case $1, we're going to immediately put the collar back on our dog. We do not want the dog running loose and getting run over in the street. Sell to open the call, buy to open the put. Okay, so how do we get out of it? Buy to close the call, sell to close the put. That's our profit, $1.97. Okay, but we don't want the dog running loose. We put the collar right back on. So the bottom line is we never, ever own these assets naked. That's how you lose a lot of money. It's also how you make a lot of money. But we're not trying to do a growth strategy. We're trying to do an income strategy. So we sell to, this is our current trade right now.
Right.
So I'm about ready to flip it. Right now, this trade is generating profits to the downside, but I'm not ready to bet down on the SPY for a very long period of time yet. So I'm ready to flip it probably pretty soon here.
It looks like you're making. It looks like you're making like 2% on each trade. I don't. How much you're making on each trade?
So the SPY costs $300, so we'd have to pull $3 credit to just get 1%. let's just see, in these trades, we made 59 cents, 81 cents.
So it's $300 a share.
Yeah, SPY cost 300 a share. We don't win 100% of the time. Here's a trade that lost 59 cents. Overall, that previous week, we made 81 cents.
Right. Per share.
Yeah, per share.
But in terms of what you're actually investing, besides holding on to the SPY, there's a return on your investment that's greater than 2%. I mean, holding on to the SPY. Does the SPY pay a dividend?
Yeah, it does. It does pay dividends.
Yeah.
But
Well,
yeah, you can look at our return. Our best month ever was 3.2.
Yeah, Victor, the SPY pays 0.9% after the fee on an annual basis.
Right.
What I would ask myself, Victor, is, what am I doing with all my assets right now? Am I really protected, or am I just kind of floating around with total risk? If you're floating around with total risk, why? Why would you want to have all the risk in the world during a period of your life where you need to protect your capital?
Right. No, I agree. All right. Well, I'm not. Yeah. So let me think about this, and let me go. Let me look at what I'm doing. I don't even know what I have. I don't.
So next time you go to a dinner party after you sign up with us, they're going to be talking about their crazy portfolios. You say, well, I only own 3 ETFs. I own the SPY, the TLT, and the GLD. And I'm killing it. And I sleep like a baby at night because I have a put option below my assets. Atomic bomb could go off tomorrow. Trump could raise tariffs. China could invade Hong Kong. Germany could collapse. Deutsche Bank could create a financial systemic risk. Nothing is going to worry you because you have put options below your assets. And you only have 2 assets to really worry about, the SPY and the TLT.
Mm-hmm.
Or you could tell them about your corn futures that are yeah, I'm just kidding. But
well, no, I mean, he wanted me to get all my people to say how well he was doing, and he was doing really well. And I was like, yeah, it's doubling my money at this point. And it was from $10,000, it went up to like 20-some thousand. But the problem is it was never retained. And and even though, and this was the thing I was trying to ask him, and he was very blustery about trying to explain it to me, but he didn't really want to, is because we were buying options that were calls and puts at different price levels. And I don't know why it lost so much money, being that we were purchasing at different values and all that. It never really explained it. So,
well, here's what I've learned is, if you're trying to make 10% return, you're probably going to have to take on a 20% risk. If you want to make a 20% return, you're going to take on about a 40% risk. So our product is trying to make 1 to 2%. So we're going to risk around 2 to 4%. And so to make money consistently, you have to know what the big picture is. You got to be on the right side of the overall move. And then you got to really manage your risk, because just one bad move and you can lose a lot. And so,
right.
Yeah, I could optimize this portfolio to have much bigger returns, but I would have much bigger losses too. For our audience, that's just not interesting to them. They're at the point in their life, it's time to play it safe. Time to put the collar on the dog and stop letting them run around.
How long have you been doing this for?
I've been involved in finance since 2008. My first
that's
job
pretty long.
was managing all these big name. I don't know if anybody's heard of John Thomas or Timothy Sykes or Agora.
I've heard of Timothy Sykes.
Yeah, so I've represented all of them. Vivian Lewis. It just goes on and on. I have good experiences with a lot of them, but at the end of the day, Number one, they thought to provide value, they had to beat the market. Now, guess what? Most of them couldn't beat the market. Two, even if they were supposedly beating the market on their track record, they're doing it with risky, illiquid products.
Right, I noticed
You know,
that.
when the trade's going to come out, you don't know how much of your capital to put in the trade. They have these complex portfolios that they've built over the past 6 months, and you don't know which trades work now, which ones don't work right now. It just didn't work for people. No matter how well the guru was doing, a very small fraction of the clients were getting the results.
Right.
So yeah, you know, after watching and learning for about a decade, and I've had other services I've put on that were successful, that were high risk, high return strategies. And then finally, after doing this for long enough, I realized, hey, who's actually buying these products? Well, it's not 20 to 50-year-olds, okay? Most of the people buying these products are at least 50 years old. Many of them are over 65. They've got a lot of cash they've saved up. They've probably lost some serious dough in the last few years trying out all these trade alert services. And they're finally waking up and realizing they need something safe and sound and consistent.
Right. No, I agree. And then the other thing is that we're running into a situation where all of our expenses increase and your earning power is going to decrease. So you have to figure out a way of actually, you know, sort of accenting your resources so that you can spread them farther. The other thing is I'm learning something from this, so I figure that's a good thing. So let me think about this. I'm definitely going to do it. I just have to figure out where I am and how I get the money together. I have to buy the SPY, and then I have to kind of get myself set up in terms of the Ameritrade account. I mean, it's there. It's just, and I haven't looked at it for so long. I'm afraid to look at it. There's money in there too that I haven't spent yet or moved. So I just have to look and see where I am so that I can do. And I do have credit card issues. I'm at 60. I'm able to take money out of my pension also, and I stopped adding to it. But I don't want to take a lot of it. For one thing, I don't want to waste it, but then the tax.
Yeah, if you do have some sort of IRA that you can move to Ameritrade, then you can. That's really nice because we are creating a lot of short-term profits. So if you do have an IRA or some sort of retirement account that you can actually manage yourself, you don't have to.
I would have to do that. I have a self-directed portion of it that is through whatchamacallit, Vanguard. And so, and my thing is then I wouldn't lose any money if I converted it to, I mean, I'm 60 years old, so I'm trying to figure out what I wanted to do with that, whether I wanted to just convert it to a Roth and then work it that way. So I have to investigate all that, and I have to call them to find out what they're going to do, what I can do. I mean, it's money I didn't have, so and then I'm not risking money that I need to spend on other things. So, because you run into issues where there's like just liquidity. I purchased for my work, and like there's thousands of dollars on my card, and I run into those problems where I'm at my ceiling or whatever. And it's not good. It's not a good feeling. So that's why I'm really trying to do this. So I like your product. I think it's a very good idea. Yeah, and I mean, I don't think it's expensive either. And that $9.97 is for a year, right?
Yeah, that's for the stock trades, Monday, Wednesday, Friday, and that's 50% off. You get the Tuesday, Thursday trades free for 30 days.
Okay.
And then I would just ask myself, how much could I lose in the next month if I don't add downside protection to my portfolio?
Right. Well, right. I agree. No,
next 30 days.
You're preaching to the
because
choir.
you don't have any put options under your assets. If you got 10, 20, 30 different securities you own, it's too hard. It's too complex to try to protect the downside on that. That's why when you consolidate, you own the SPY, you own the TLT, you have put options under both, and you're selling call options for income. It makes your life very simple.
Yeah. The other thing is that, so the aspect of the ownership of the SPY does not concern you. In other words, like this, the sort of in an eventual downturn, it doesn't matter to you, considering how you, in other words, say the stock market loses 50% of its value. It doesn't matter with your product that could happen, does it?
Right, that's the whole point. So yeah, actually the way the option market is skewed, we can actually make a little bit extra if the market moves down and we do this trade. And that's just because the market hasn't gone down for 10 years, so it's skewed to pay out better that way. But yeah, exactly. We have put option below the SPY. So in this trade right here, the SPY could go to $100 tomorrow. How much would we get per share? You tell me.
291.
291, yeah.
All right.
Now you got to ask yourself, with your portfolio, stocks crash 5% tomorrow. Do you have any protection at all?
No, I don't. But I don't own any of the SPY stocks either.
Yeah, but do you own any stocks? What stocks do you own?
I don't even know at this point. I have to check.
Yeah. So guess what? Individual stocks fall way harder than the SPY does. The SPY has 500 companies. A lot of those are defensive companies that actually can do well in a down move. So if the SPY goes down 1%, your normal stock's probably going to lose 2 to 5%.
Yes. Well, so this is, I mean, I'm interested in all this, and I'm one of those, like, I'm more like a chicken. I sort of peck around at different things and turn them over, and, if I find something that's interesting to me, then I mull it over, and then I'm going to put that money out once I get myself consolidated. I managed to do it for this. He's gonna be crazy with me, but he's in Miami. Then I'm going to pull the money out of that. I mean, there's no. Once the volatility came in, and we lost the money, we went into cash. So there's money there too.
Yeah, it's important. Karen mentioned this in the live chat. She's actually one of our members. You don't want to just own the stocks or the bonds naked. You want to own it with the collar. So we have this collar on our trades 100% of the time. I see Kate Main has a question. Kate, or Mian, you have your mic muted. If you want to unmute yourself, you can talk out loud. Okay, why do we need to buy the SPY ETF? So our strategy is something like being a bank, but instead of lending out dollars, we're loaning out the most popular stock in the world, the SPY.
Right.
We can still trade the spread. You can try to do something similar, but now you're paying for option premium by buying call options, and it's not as profitable, and it does not work the same way. You'll end up with a setup where you might make a bigger return, but you can lose a lot more. So I'm afraid there really is no way to shortcut this strategy.
Exactly. You add so much risk.
Yeah. So, we're trying to make a very small return over and over and over with extremely low risk. And the only way to do that is to own the asset. And this is the best asset you could possibly buy. Try to sell me on any security that's better than the SPY. Good luck. So yeah, if you turn it into like a spread, the risk reward is, okay, now we can make 10%, we could lose 30%.
Right.
So we're taking advantage of people who want to buy call options. And we're also taking advantage of big banks who are happy to sell put options because they want to buy the shares anyways. They're happy to buy the SPY because, you know, they sit there and sell these put options 24/7, right, and just pull in tremendous money. And if they ever get assigned, they don't mind. They're happy to buy the SPY.
Right.
Because they're also, you know, protecting the downside by with their supercomputers. So yeah, we're taking advantage of two sides of the option market. Call option is mostly gamblers who want to speculate that things are going to keep going up. They're trying to double their money in a 48-hour window. Most of the time, they just lose. And on the other side, the underwriters, the big Wall Street banks who are willing to sell put options, you know, they're doing it at every strike on every stock with computer systems that are incredible. And they make a ton of money doing it until a big crash comes.
Right. So it's interesting. Very interesting. I'm checking to see what I have in this account. I haven't looked at it for a long time.
Yeah, it's time to consolidate and make your life simple. You shouldn't have to, you know, you should know. I got 1,000 shares of the SPY and I've got 2,000 shares of the TLT. I've got a put option below both. Life is easy.
Oh boy.
Any other questions out there, guys? I got a question from K Press. Go ahead.
How much of the GLD do you own?
Let me check. So we have 40% in the SPY, 40% in the TLT. So make your life easy. For every 1 share of the SPY, you should have 2 shares of TLT.
Okay.
So this really makes your life so easy. All you got to watch every day is the SPY and the TLT. You'll know exactly what's going on with your portfolio.
So what do you do with the GLD?
The GLD, yeah, that's buy and hold. So yeah, we have 40 in the SPY, 40 in the bonds, and 10 in gold. 10%. That's just buy and hold.
Okay.
I have a lot more in here than I thought.
What's that?
Well, I have a lot more in here than I thought, which is actually a good thing. So, well, because I have a lot of like mining stocks. So they all, you know, all those kind of things that were Goldie heavy or whatever, they all went up. That's not as bad as I thought it was going to be. That's good. That's good. So then I can do all this. There's almost $7,000 in there, so that's not too bad.
Kate has a question. Do we need to buy the TLT also? So Kate, a lot of our clients like to start out just with the SPY, become comfortable with the program, and then it's optional. If you want to add in the bond market to your portfolio, I highly recommend it. I think it's a smart move to have 100 shares of the SPY and then to have 200 shares of the TLT. And the reason why is usually if the TLT goes down, the SPY goes up. If the SPY goes down, the TLT goes up. And so by combining the two, it makes it very hard to lose. So you can see when we combine those track records, we only have 1 losing month. Oh, thanks, Kate. Appreciate the compliment. Robert, do you have any questions? All right, guys. Well, thank you so much for all your time on today's webinar. We have another trade alert coming out tomorrow. Let's see what the SPY is at just for fun before we get out of here. 284.42. So let's just see for fun how that trade is doing. Most recent. So our latest trade is this one right here. We sold to open the 285 call, and we bought the 286.50. When we put this trade on, the SPY was at 286.22. So your bag holder is lost $2 or no, $1.80. That's how much most people are down who own the SPY. If you own individual stocks, you're probably down a lot more than that. So that's almost a 1% loss from when we put this trade on for bag holders. But for us, we're now at the maximum profit. So as long as we're below 285, this trade generates $100 profit. So probably the time to flip the collar is coming soon, but we were able to do very well in this recent downturn. Good job, Karen. She took the trade and the last trade. She's been doing well.
Nice, Karen. Love it. Good job.
On a roll. Keep it rolling. Yeah, we're you know, it's funny to celebrate making $100. It may seem like chump change, but you know, if you have 1,000 contracts, Karen would have made $1,000 in a 48-hour period. Now you do that 3 times a week, 52 weeks a year. Now we're talking.
Yeah, no, it's great.
All right, guys. Well, we'll have another webinar Thursday. Remember, immediately after the trades go out, we have that live stream. So you can talk, you can chat. The live stream is on YouTube. It only has a chat feature, so you can type for the audio conversations, which is a lot more personal. That's on Zoom webinars. All righty, well, that's a wrap. Thank you guys for your time, and looking forward to continuing to get you good trade alerts. Monty says, thank you, like your program. Thanks, Monty. Great to hear from you. Glad you stuck around to our webinar today. And we had something like 25, 30 people on, so continues to grow, and thank you all for your time.
Thank you, Jason. Thank you all for your time.